and today we are going to discuss a weekly ratio spread strategy. In this podcast, we will discuss the background, when to execute, how to execute the strategy, example, important level, advantages, disadvantages, how to make adjustment, and bottom line. Before going through a discussion, I just wanted to mention that if you want to read the full article about this, the link of article is mentioned in the description. So let's discuss what is the background of this strategy. Weekly ratio spread strategy is a strategy mainly focused on selling options in a ratio to get the credit in premium. This strategy involves two leg, buying leg and selling leg in the same period of expiration. When to execute. Weekly calendar spread is a non-directional strategy which has to be deployed when the view about the market is a range bound. Here the key is to establish support and resistance level in the market and try to take advantage of an option premium decay. How to execute. Weekly calendar spread is consist of a two leg, buying leg and selling leg when the option sold in the current week expiry and option buy in a current week expiry which is near OTM compared to the option sold. Let's take an example. Let's see if the Nifty is currently trading at a level of 16,000 in the first week of Jan 2021. Then first we need to draw a support and resistance level. Let's say 15,800 and 16,200 are respective support and resistance level. In this case, we will sell two put option of a 15,750 and two call option of a 16,250. And to hedge this, we will buy a one put option of a 15,800 and one call option of a 16,000 of the same week. Here notice that we are selling two options from both the side and buying only one option, and that is near to the current market. So this gives us a net premium position on the both side. Let's discuss the important levels. The net inflow over here is the amount of a premium which we received. The lower break even will be a strike of a put sold less net premium, and for the upper break even, strike of a call sold less net premium. Maximum profit would be the amount of premium which we received, and maximum loss will be a difference between all these strikes less the net premium which we received. Margin requirement. Over here we are not very sure about the consistency of a margin because of a recent SEBI guidance which is dynamic and changing continuously, but as far as we are taking it to a safe zone, the amount will be required is 1,50,000. Last, we will have discussed the risk and reward ratio. Over here, since we are selling two options and buying a one option, that means the risk is a technically unlimited. That's why we cannot describe the risk and reward ratio. But since we are taking huge gaps based on the view of a support and resistance, we should assure that we are able to handle it properly, and we will discuss the pros and cons in future. So let's discuss the advantages of this strategy. This strategy requires less margin as 1,50,000 without leverage, and this strategy is constructed to get the theta decay by overnight position. Weekly ratio set strategy can handle a little bigger movement and it is easy to deploy. The adjustment which need to be made are very easy as it's require only buying an option, which will be discussed further. This strategy can protect from huge delta move and it is best for the sideways market. Let's discuss the disadvantages. The major disadvantage is since we are selling an option 2 and buying an 1, that's why it is a naked strategy and not provide a full hedge strategy. Any wide delta move or any direction based view of a market can change the dynamic. If our views goes wrong or the possibility of support and resistance are important. Also, these strategies are not viable for black swan event. You should also consider that these strategies are carry overnight risk. Now let's discuss the adjustment. Over here the adjustment is very simple. for any down move we have to buy only the put, and for any up move we have to buy the call at the respective break even level, and our losses will be taken care of. Let's discuss the bottom line. Weekly ratio spread strategy used in a non-directional market, and this strategy carry a theta decay because we consider it is an overnight position. It is easy to deploy and adjust as we discussed. Thank you for listening to us. If you have any query, you can just mention in the comment section, and for the article we have provided the link. Thank you for joining with us.